A very warm welcome, everyone, to the Maritime Education Podcast. My name is Barry Sadler, and to those of you who are familiar and returnees to the podcast, welcome back. To our new listeners, a very warm welcome extended to you guys. It's great to see you here, and I hope you find something in the podcast that interests you, and if you're studying for a certificate of competency, or even just maintaining your continued professional development. There's something in these podcasts for everybody from an educational point of view, right from a cadet all the way up to master mariners. So please do enjoy. In this podcast, I'd like to talk a little bit more about some of the ripple effects that are coming out from the Iran conflict. We're now some weeks into the Iranian war, where the US and Israel have led attacks on Iran for various reasons. But I'm not going to focus on the political side of things. I want to focus on the effects to shipping, and in particular, the ripple effects that have gone out and affected global shipping. The media tend to focus on the shipping in the Strait of Hormuz and those ships that are trapped within the Gulf area, but I'd like to focus on what's happening to global shipping as a result of the war in Iran. But before I move away from the Gulf area, I just want to spare a thought for those guys that are working on ships that are currently trapped within the Gulf. So those that are effectively the wrong side of the Strait of Hormuz. It's really important that we, as mariners, as other countries, as those who are concerned for the well-being of seafarers in general, spare a thought for those lads and lasses that are trapped the wrong side of the Strait of Hormuz. The Strait of Hormuz is practically closed, as we've seen there through a lot of media reports. Iran has threatened retaliatory attacks on ships that use the Strait of Hormuz that are in any way allied to either the US or Israel. And that has effectively closed the Strait of Hormuz. That, combined with the prohibited costs of war risk insurance and the fact that a lot of insurance has been withdrawn from ships that were operating in the Gulf area, means that the transit of the Strait of Hormuz is closed not just by force, but closed by defunct, really, due to the fact that ships are unable to meet their insurance obligations in order to transit it. Insurance is something that I want to focus on today when we talk about the global effect on shipping, but we'll come back to that later on in the podcast. Returning to those guys and girls that are trapped on the wrong side of the Strait of Hormuz, spare a thought for those guys. There's a lot going on there at the moment. Ships are being attacked, and if you're at anchor inside the Strait of Hormuz, or even if you're alongside a port in a friendly country within the Gulf area, you are still prone to attacks from Iranian missiles, and therefore it's a really difficult place to be at the moment. It has been declared a war zone by various organisations, and therefore the right to be repatriated exists for those seafarers that are operating in that war zone. The trouble that a lot of ship owners have is that moving their ships to a safe port to be able to enable that repatriation is almost impossible, as there are very, very few safe places now within the Gulf. Moving on, let's talk about some of the global ripples to shipping that have come out of the Iran war. The first one was something that we reported on last year, and that was the re-energising of the Suez Canal. Now, the Suez Canal has, for several years now, been very, very quiet. Traffic through Suez has been rerouted around the Cape of Good Hope due to the fact that the Houthis were attacking shipping in the Red Sea, meaning that because of the price of premiums to send your ship up through the Red Sea, that's insurance premiums, combined with the price of a canal transit, made it financially prohibitive for operators to send their ships through there. In 2026, CMA, CGM and Maersk had officially planned to start to send ships back through the Red Sea. Attacks had dropped off and the war risk premiums were slowly coming down. Now, because of what's happened in Iran, the Houthis have resurged. In solidarity with Iran, they have threatened commercial shipping coming through the bottom of the Red Sea there. That's the Straits of Bab el-Mandab, or Hell's Gates they are known as, because the weather there is so hot. Drone and missile attacks have been threatened, and therefore CMA and Maersk have officially shelved their 2026 plans to return to the Suez Canal, reverting once again to the long detour around Africa's Cape of Good Hope. We've even seen the massive disrupt in shipping between the Mediterranean to Indian loops that are there, in that they are almost forced to use the dangerous passage through the Suez Canal, because literally that is the shortest route between those two countries by a long way. It's not like coming from the Far East, where going around the Cape of Good Hope adds a few thousand miles. Going around the Cape of Good Hope when you could just go 1,000 or 2,000 miles through Suez is a massive detour. But nonetheless, carriers on these Indo-European routes have decided to go round the Cape. Now, what's the cost of going round the Cape? Well, the cost to the ship owner is, of course, in fuel. And the ship owner has to weigh up the costs of fuel against the costs of insurance going through the Red Sea. But the price of fuel is going sky high at the moment, with 20% of the world's fuel coming through the Straits of Hormuz. This has created a supply and demand problem which has pushed up the price of fuel. And as we speak today, on the 24th of March 2026, we're over $100 per barrel of oil. So the price of fuel has risen dramatically, and that has a huge effect on the ship owner. Rerouting round the 3,500 miles extra south of the Cape of Good Hope means using an extra 10 to 14 days of fuel every voyage. So that's every voyage to and from the Far East. Now, to maintain the weekly schedules with these longer routes, shipping lines have got to use more ships in order to provide the service. And some analysts have estimated that this absorbed over 2.5 million TEU of global capacity, which has turned basically 2026's predicted vessel surplus, particularly on the container front, into a shortage. When you've got a shortage of tonnage, that pushes freight rates sky high, and that's another thing that's happening, is that the economic fallout is huge, with freight rates rising on a rapid basis. Empty containers are a problem as well at the moment. They are increasingly stuck in the wrong ports. They're piling up in Europe whilst they're scarce in Asia and the manufacturing hubs, which of course again is driving up costs for shippers who never even enter the Indian Ocean. This shortage of containers needs sorted out, and the reason it's there, again, is the rerouting of ships. What I want to focus on, though, is some of the economic and in particular the insurance fallout from this. Now, we've talked about bunker fuel surcharges. With oil prices as volatile as they are and the thousands of extra miles that the owners have to send their ships through, the bunker adjustment factors or fuel surcharges applied to freight rates are rising globally and rising rapidly. Another effect on this is that air cargo fees are also rising. Because maritime at the moment is seen as a bit of an unreliable way of getting your goods from the Far East to Europe due to the ever-changing political situation, this means that high-value goods are being shifted to air freight, which has pushed up some air cargo rates by over 20% on the Europe-Asia routes. So high-value cargo switching across to planes hasn't helped. But where we've seen these rises in freight rates, surcharges, and the air freight rises, some of the biggest rises and biggest problems that we are seeing globally are that in the insurance market. Now, in order to sail in areas like the Red Sea, or indeed if you're able to in the Gulf's area, then there are extra insurance bolt-ons that a ship owner must pay for in order to insure their ship within those areas. Now, the Strait of Hormuz, the southern area of the Red Sea, the Gulf of Aden, and indeed the Indian Ocean are now seen as very, very high-risk areas. And before the Iran conflict kicked off, they carried a very, very large, what we call war risk premium. War risk premiums are a bolt-on to a regular insurance underwriting, which we'll talk about a little bit later on. I'm going to explain insurance in a lot more detail. But a war risk premium is basically what the ship owner would have to pay extra on top of their regular insurance payments. Now, those four areas that I mentioned, so Strait of Hormuz, Southern Red Sea, Gulf of Aden and Indian Ocean, have all seen dramatic rises in these bolt-on costs. Now, the Strait of Hormuz and the Persian Gulf, they have gone over 10% of the value of the ship as a war risk premium. So that's a huge amount that a ship owner has to pay. 10% is just completely prohibitive from a financial point of view, but as we've already discussed, a lot of insurance companies have withdrawn their insurance for any ships to transit the Strait of Hormuz anyway, so that really nullifies it. Just to give you an idea of what it used to be, the pre-conflict rate for going through the Strait of Hormuz was around 0.25%. So although it was seen as a high-risk area, the pre-conflict rate was way, way down. But as I said at the beginning of the podcast, let's come away from the Strait of Hormuz, the southern Red Sea, which is now an active conflict zone due to the resurgence of the Houthis. Prior to the conflict, things were getting much better down there, and we were looking at around 0.2 to 0.3% of the value of the ship as a war risk premium. We're now looking at around 2%, so basically 10 times the premium. The Gulf of Aden, that's about the same. That was 0.15%. That's increased to 1.5%. Again, 10 times the premium for operating in the Gulf of Aden. The Indian Ocean itself, the expanded zone in the Indian Ocean, pretty much no war risk premium down there, despite the fact that it was very, very close to these conflict zones, despite the fact that piracy was ever present in the area around Somalia and through the Safe Corridor. The war risk premiums pretty much didn't exist before the conflict. Now, even to go across the Indian Ocean is going to set you back 0.75% of the value of your ship as an extra premium. At the end of the day, they are the extreme values that I've quoted, and a lot depends upon whether the ship is a magnet to these Iranian missiles or not. Any ship that is US owned, flagged or carrying US cargo is of course a massive magnet to an Iranian attack, and therefore is going to carry the very, very highest of those increases. The Hormuz Gauntlet, as they call it now, ships are facing increasing costs to even run through that Hormuz Strait, even if it were open. It's not open, as we said before, due to the threat of attack and due to the fact that insurance companies aren't just putting up prices there, they are pulling their cover for ships that are going through there. The US and China have put in place insurance, reinsurance plans, and these help ship owners to top up on their insurance, which is fine as long as they can get that insurance. Both the US and China have pledged money to be able to do this, but so far the underwriters don't have the appetite even to take that large amount of money. The United Kingdom and the G7 multilateral support hasn't launched anything yet, but it's talking about a war risk fund, just like the Americans, in order to offset some of these insurance costs. But once again, we don't have any insurance that's viable at the moment. But I want to talk to you about ship insurance in general, because here we are talking about the effects of the Iranian war, and ship insurance can sometimes be a bit of a, I was going to say minefield, but you do excuse the pun. It can be a difficult area to negotiate, and it's basically split up into three main types of underwriting that a ship owner will have. The first underwriting we know is called hull and machinery underwriting. Hull and machinery covers the physical body of the ship, so the hull, the engines, its fixed equipment, and it covers groundings, collisions, engine failure, that sort of thing. It does not cover war risk, and therefore your hull and machinery will not cover you if, for instance, your vessel is hit by a missile. Or seized by a navy. The hull and machinery insurance will not pay out if that's the case. You've got to bolt on that war risk policy. The second type of insurance you can get is what we call P&I insurance, Protection and Indemnity. This is the most common form of insurance when it comes to that's required by the IMO's several conventions, and that protects the ship owner. P&I indemnity basically covers third-party liabilities, so things like spilling oil, damaging piers, repatriating crew members, injured crew members. This is the sort of thing that the protection and indemnity underwriting will cover. Any third party. Don't forget, it's for the ship owner, and as far as the ship owner is concerned, the master and the crew are a third party because they have a contract with them. So that's when we say third party liabilities cover the crew and the master. Third type of insurance is cargo insurance, which we would expect the shipper, not the ship owner, to manage. This is insurance that a shipper has against cargo being damaged and various risks that the cargo is put through. Once again, cargo insurance a little bit separate to those that are interested in perhaps marine insurance, but nonetheless it can have a very, very technical effect on ship insurance, particularly in the case of collision and things like that. Now, what we've got to think of with regards to these insurance really is what marine insurance policies are mandatory to the ship owner. And you would be surprised what is legally mandatory through international conventions and those that, shall we say, are commercially mandatory. In other words, if you don't have the insurance in place, your ship's unable to operate commercially. Now, P&I insurance, protection and indemnity insurance, that's the most, shall we say, legally mandated insurance through international conventions and flag state laws. Now, it covers quite a lot of little bits and bobs under that, what we call the P&I insurance. Big things that are covered are, of course, the bunker convention. So the bunker convention basically covers oil spills from the ship's fuel if the ship is damaged or sinks. It covers wreck removal under the Nairobi Wreck Removal Convention, that basically pays to remove the wreck from the seabed of a signatory nation, and it covers the crew in various aspects. So it covers the crew for repatriation, covers the crew for death in service, it covers the crew for accident, medical cover for that. P&I will also pick up the bill in a collision. It will pick up a quarter of the bill from a collision. So P&I clubs are there as a, shall we say, the only legally mandatory cover. Now, it's only mandatory for those three things that I mentioned, and that's bunker oil, wreck removal, and the various crew bits and bobs. Commercially mandatory insurance, in other words, stuff that's not required by law, but you've got to have it to run a modern shipping business. The big one is, of course, hull and machinery. Now, at the end of the day, if you don't have a hull and machinery, and of course, over 90% of ships do have hull and machinery underwriting, then you're not going to be able to trade. At the end of the day, hull and machinery isn't just there to protect the ship owner. Hull and machinery is there to protect the maritime adventure as a whole. And nobody's going to pay a carrier, invest in a carrier, or get involved in a maritime adventure unless that ship owner has protected themselves against the loss of their own vessel. Because suddenly going bankrupt as a shipping company can have a massive effect on cargo carried by other ships within the same company. Routes and future contracts are also going to become massively affected if that ship owner's unable to replace or pay for the damage to their own vessel. Now, the other type of insurance that, of course, mandatory is your civil liability insurance. Civil liability insurance is basically the insurance that you need for oil tankers that carry more than 2,000 tons of persistent oil as cargo. It ensures that strict liability for the ship owner is upheld by civil underwriting, in other words, by having insurance for it. Even if the spill wasn't their direct fault, then that insurance is picked up and the oil is cleaned up despite that. Passenger vessels have an extra mandatory insurance, which we'll mention quickly, under the Athens Protocol of 2002, and it requires that ships which are licensed to carry more than 12 passengers on international voyages must maintain insurance of a specific amount per passenger for death or injury, repatriation, and claiming against personal effects. This was brought in because over the years, particularly ferry services have let passengers down, where they have become stranded in countries where the ship owner has been unable to fulfill their obligation. So basically, there are the four big, if you like, IMO mandates that require statutory underwriting. It's the Bunker Convention for fuel oil spills, the CLC Convention for cargo oil spills, the Nairobi Convention for wreck removal, and the Athens Protocol for passenger injury and death. We've also got the abandonment and repatriation, death and medical cover, which comes under the Maritime Labour Convention. But who, at the end of the day, insures ships that require this? Well, the biggest type of insurance, as we've already explained, is that comes from a P&I club, a Protection and Indemnity club. Now, Protection and Indemnity clubs are a mutual insurance association of ship owners who pool all their resources together to provide coverage for these third-party liabilities. So unlike standard insurance companies, a P&I club is a not-for-profit organisation. It has no shareholders, and it's owned by the ship owners themselves, the members of the club. In a standard insurance model, you pay a premium to a company. If they have money left over after paying claims, they keep it as profit. But in a P&I club, because they are mutual and not-for-profit, then if they are over budget, in other words, if the claims are less than the money put in, Then the money is either returned as a proportion to the ship owners, proportionally for the amount of tonnage that they have, or it's put into the next year's budget in order to bring down the premiums that these ship owners pay. Now, unfortunately, there is a call system within a P&I club. Now, this is something that no ship owner wants. If the claims exceed the amount of money invested by the ship owners within the club, then the club makes a call for extra money. And this means that anybody in that club who has an interest must make the money available. Asking members for more money to cover the gap is something that you take. It's a risk you take when you join a P&I club. Okay? P&I, protection and indemnity. Yep. Protection basically is liabilities that arise from owning the ship. A crew member getting injured, a ship hitting a bridge, or a shipwreck that needs removing, something like that. And indemnity is a liability arising from the business of carrying cargo. Yep. So oil leaks or grain rots or something like that. So that's what we mean when we say protection and indemnity clubs. At the end of the day, a protection and indemnity club will look to break even. In other words, it's a mutual benefit for all of its owners. It can call in extra money from its members. It specialises in maritime law and claims, and the limits on P&I clubs are extremely high, and globally those limits can be as high as $8 billion. So at the end of the day, P&I clubs are a really, really important part of marine insurance. Now, ships, to prove that they have this P&I insurance, carry what's colloquially known as a blue card. Now, a blue card goes back in history to when certificates for underwriting by P&I clubs were physically printed on special blue paper to prevent forgery, and that's why they are called a blue card. But a blue card is essentially, and these days, a digital way of proving that you have the underwriting that you are required to have by law. So in other words, if you pull up into a port and that port state officers come on board and want to verify your compliance with, for instance, the Nairobi Wreck Removal Convention, they'll look to cite this blue card or this blue e-certificate in order to show that you are indeed covered. There is a specific certificate, the wreck removal certificate, required on ships of over 300 gross tons and is issued by the flag state themselves, but the flag state won't issue that unless they see the blue card from the insurance company itself. It is important to recognise that, as well as P&I clubs, hull and machinery insurance is provided by a completely different set of, shall we say, heavyweight insurance companies. These heavyweight insurance companies aren't there on their own, in that hull and machinery costs are so huge that a lot of underwriters for hull and machinery won't take on the risk themselves. Now, London was traditionally the hub for hull and machinery underwriting, mainly through Lloyd's of London. And Lloyd's of London, don't forget, is not a single insurance company. It's a marketplace. And inside the Lloyd's building in London, various syndicates pool their capital to take on maritime risk. And that's what Lloyd's do. Lloyd's pull in other insurance companies to make up the percentage required to cover the 100% risk of underwriting a hull. Very, very few insurance companies, so we're not talking P&I clubs now, very, very few insurance companies will take on the underwriting of Hull and Machinery as a single entity. A lot of it will be farmed out to other insurance companies through things like Lloyd's of London pulling everything together. Recently, though, London slipped a little bit within the insurance market, and the Nordic market are now the undisputed kings of marine insurance today. Guard, which are the largest global provider of hull and machinery cover, are based in Norway. Skuld, another Norwegian company that provide a massive amount of hull and machinery. Now, at the end of the day, whilst these guys are your, shall we say, regular insurance companies when it comes to maritime insurance, they are often operated by brokers, those that go around and basically pull together the money that's required to cover the 100% of the ship's value. So basically what an insurance broker will do is they'll go into the insurance market and they will look for these hull and machinery insurers to take on a percentage of the risk of a hull that needs insuring. So one company might take 10%, one company might take 5%, one company might take 2%. Smaller vessels, you may find a company taking a big proportion, 50 or 60% of the risk. Obviously, that entitles them to 50 or 60% of the premium that's charged, but the broker will sort all of that out. So marine insurance is very, very rarely covered by a single entity when it comes to hull and machinery. Real problems can exist, however, particularly in collision cases where you've got your hull and machinery cover provided by one person and your P&I club, your P&I cover, covered by another. And that's why the modern way of ship insurance is to have companies that work in both. So a great example is the first one that I mentioned there, Guard, the Norwegian company. Guard are both a hull and machinery underwriter and a P&I club. And so therefore they have a branch of the P&I club that deals with hull and machinery, that does make profit, and an arm which is the P&I club, which, as we discussed before, is a mutuality, which means that they are not for profit, they are for the good of the investors, i.e. the ship owners. Why is this important? Well, it's important because it simplifies things, really. A ship owner that has had an issue only needs to make one phone call to one organisation in order to start the claim and start to put the ship owner back into the position they were before the incident or claim happened. But this is particularly important when it comes to ship collisions, and particularly important in cargo claims in ship collisions. As we said before, if a ship has a collision, then the P&I club will pay a quarter and the hull and machinery will pay 3/4 of the damage to the ship itself. Now, as I'm sure a lot of you are aware, when it comes to collisions at sea, courts are very, very unlikely to apportion a 100% blame to just one ship. The collision regulations themselves place the onus on more than one vessel in most situations to take some form of action to avoid collision. So in a collision, it's up to the courts to decide not necessarily who was to blame 100%, but to decide what the proportion of liability goes from one ship to the other. Now, the real problem comes about where you split this liability. Why? The value of the ships, that's absolutely fine. The value of the ships is dealt with by the proportion of the claim, and that's something that doesn't really come up for dispute. So if one ship has £10 million damage and the other one has £15 million damage, the total liability is £25 million. This is split as per the court's liability, and then if it's 50-50, for instance, on a 25 mil claim, that means that each ship owner's got to pay $12.5 million. That means that a quarter of that's paid by the P&I Club, 3/4 of that by the hull and machinery. Job's done. The problem comes about where we have shared liability in a collision when it comes to cargo claims. And basically, if the cargo on one ship is lost, then those cargo owners can claim against not just the ship on the cargo was being carried, but because a proportion of the blame goes to the other ship, they can claim against the other ship as well. But under P&I rules, basically, if they can show that the fault was one captain or the other, and in the case, let's say, of a 50-50 claim, they can show that, then it ends up with the ship whose cargo was lost having to reimburse the other vessel for the cargo losses because they were partially at fault. A 50-50 claim means that everybody was equally to blame for the collision. This can get really, really technical, as one cargo owner sues the ship that their ship hit, then that ship then sues the ship that the cargo was on for their share of the fault, and then the cargo owner must reimburse the first ship. It just gets very, very technically difficult to work out who pays what. Now, there are insurances that can be put in place to cover a lot of this to and froing that happens in a shared liability collision case, but one of the quickest and easiest ways for the dispute to be worked out is if the P&I Club and the hull and machinery underwriters are the same people. That way, there's no challenge of interests going from one ship to the other in these convoluted claims. Everybody's singing from the same hymn sheet, and the proportion of the payment and risk that's doled out is a lot fairer and a lot easier to deal with, rather than having to go through several courts in order to make these convoluted claims. So the easiest insurance for a ship owner to have would be to have their hull and machinery and their P&I insurance through the same entity, and that means that we are not pulling in two different directions when it comes from who's liable, particularly for the cargo interests in a collision with shared liability. And as I said, 99% of collisions do have a shared liability. Very, very few are 100% one ship and 0 for the other ship. Now, a lot of this can basically be, shall we say, convoluted even further when we talk about negligence and incompetence. Now, negligence has very, very little effect on some basic insurance clauses. Negligence is a one-off mistake, and if the master or crew are shown to be negligent, then they are going to share a proportion of the blame. And negligence is very, very different to incompetence. Now, incompetence is a systematic defect. The master doesn't just make a single mistake. There was a history of ignoring protocols. There was a string of mistakes that went unchecked. Now, this string of mistakes could be something that the ship owner may have been able to prevent by doing due diligence as to whether or not that master was competent or not, by reviewing the master, by ensuring that the safety management system had checks and balances in place to ensure that the master's professional knowledge remained up to date. If it didn't, and the master or crew were found to be incompetent, now that's very, very different to them being negligent. Negligent basically shares the liability, whereas incompetence makes the ship unseaworthy. And once the ship is unseaworthy, the ship is no longer covered by a lot of its insurance premiums, and that really does cause a fatal blow pretty much to the ship owner. So at the end of the day, Hague-Visby are a set of rules that talk about the carriage of cargo and the carrier's duties. And the ship owner has an absolute and non-delegable duty to exercise due diligence to make their ship seaworthy before the voyage begins. And not doing your due diligence on your master, if your master turns out to be incompetent, or indeed any of the crew turn out to be incompetent, then the courts will rule that the ship owner failed in their duty of that due diligence, and the ultimate consequence of that could be that a lot of the underwriting all of a sudden becomes useless, and the ship owner is in a position where a lot of the liabilities will directly come from their pocket, and therefore they will find themselves in a very, very difficult position financially. I hope my description of insurance and my debate on some of the ripples of consequence coming out from the Iran conflict have been interesting to listen to. Marine insurance is a very, very technical subject. It's not something that seafarers get involved in too much. We do the basics when we do our master's certificates, and when you are studying for a COC, what I really do mean the basics of ship insurance. Stuff like general average, who the charterer is, what some of these insurance clauses are. We study our conventions, and we know what certificates that we've got to have. We know what mandatory underwriting we actually have to have. But as mariners, we have very, very little knowledge of the insurance market and how these insurance liabilities are dealt with by the individual companies, and hopefully I've enlightened you on that. Thank you all very, very much for listening once again to my podcast. Please do subscribe to the podcast. We've got lots of subscribers. We are now well over 10,000 downloads. So thank you all very, very much for achieving that amazing target. And I hope you all continue to both download and enjoy the Maritime Education Podcast. Have a great day, everybody, and we'll speak to you again soon. Thank you all for listening.